Good evening. I'm glad you're here. Let your shoulders drop, unclench your jaw, and take a slow breath in and out. Before we begin, a gentle ask. If these relaxing business stories help you wind down, please like this video and subscribe. Your support keeps more calm, thoughtful episodes coming. Dim the lights. Get comfortable. Let the day step back. We'll move at an easy pace, clear language, steady rhythm, so the complex feels simple while you settle into rest. If you drift off, that's perfectly fine. You can pick up the thread next time. Tonight, we're going to Houston. An elevator hums and city lights soften at the edges. We'll slip into an executive's shoes and gently unpack what mark-to-market means, how hedges can fail, why liquidity tightens when confidence thins, and how culture nudges choices. All in plain English, all unhurried. When you're ready, let the story begin. You are alone in a glass elevator, drifting up through a bright atrium. The floor numbers blink softly like a metronome. 29, 30, 31. A paper cup of coffee warms your hand. Houston spreads out below like a foldable map. Inside the elevator, there's a steady mechanical breath, your reflection, your thoughts. You are an Enron executive. You know how to make numbers behave. You tell investors that volatility is opportunity. You tell yourself that complexity is a moat. You tell your team, gently, that the market rewards innovation. Sleep has been thin. The spreadsheets keep calculating in your dreams, like waves that never quite reach shore. The doors open with a hush. A carpeted hallway, phones murmuring, a printer sighing somewhere. You pass a framed poster about vision and values. You do not slow down. You breathe. You enter your office. You close the door with the softest click it can make. On your desk sits a binder you don't need to open, because you already know what it says. It explains how you can recognize profits on long-term contracts today. Mark to market. You value the future now, estimate years of cash flows, book gains in the present, and promise to manage the risk later. In warm lighting, it feels like innovation. Under fluorescent lighting, it looks like a guest that never stops needing you. You've told analysts this is standard for trading activities, forwards, swaps, options, even transportation commitments, measured at fair value and routed through other revenues. You said it evenly because it is true. And because it must be true. The method works when markets are liquid, models behave, counterparties pay, and curves make sense. The method also works when a charismatic executive asks a desk head, late at night, if there's a way to make the quarter look less uneven. You sip coffee that's already turned. Outside, ringtones, shoes on carpet, the relieved laugh after a deal clears. Somewhere, a junior analyst updates value at risk. Somewhere else, a lawyer edits boilerplate, a pencil tapping time. You turn the binder face down. You stare at the phone. You keep a simple version of mark-to-market ready for new hires who don't speak finance yet. Imagine you sign a 10-year contract to sell electricity. Old school accounting would recognize revenue as you deliver power each year. Mark-to-market says, if you can estimate the fair value of the entire 10-year deal today, you can book the profit now, then true it up later as the market moves. It's like agreeing to cater weddings for a decade and counting the tip before the first cake is baked. Not illegal, not automatically wrong, but it asks your models to be fortune tellers. If your forecasts are right, fine. If they're rosy, you're borrowing tomorrow's applause for today's earnings call. That's the first quiet way being an executive here starts to hurt. The calendar stops matching reality. Your numbers tell a future you now must live up to. You're no longer just managing a business. You're managing a promise the spreadsheet already made. You remember the first time a reporter asked plainly, "How exactly does Enron make its money?" You remember the headline and the strange feeling of trying to explain a company that felt like a constellation, visible, bright, almost impossible to draw with one line. You welcomed scrutiny. You said the word innovation so many times it became a flavorless lozenge on your tongue. The question still hums in your ear, like a fluorescent bulb you haven't replaced. You learned then that opacity is fine until someone leans in and says, "Point to the cash." On another floor, there's a different climate, a trading desk fluent in adrenaline and nicknames. Death Star, Fat Boy, Ricochet, Get Shorty. In memos, these become scheduling strategies. Elsewhere, later, regulators call many of them gaming. Circular schedules that conjure congestion on paper, day-ahead reshuffles that monetize real-time scarcity, exports and reimports that slip around price caps. You learn the phrases from PDFs that are somehow both dry and scalding. And then there are the tapes, traders laughing, teasing Grandma Millie, delighting in $250 per megawatt hour while the grid creaks. Your chest tightens when the transcripts hit the evening news. It isn't the profanity. It's the miles between the jokes and the values on the wall. For non-energy listeners, you keep a picture. The grid is a giant, very strict airport. Planes, megawatts, must take off and land on exact runways, transmission lines, at exact times, schedules. If too many planes are slotted onto the same runway, the airport signals congestion. Prices spike to persuade some flights to shift. Traders don't fly literal planes, they file flight plans. If the market design pays for relieving congestion or for moving power in and out in certain patterns, clever people can file a lot of helpful-looking flight plans without much actual flying. That can be legal if it truly helps the airport run better. It turns shameful when the flight plans are theatre. As an executive, you inherit that theatre as culture. You may never file those plans yourself, but you own the stage and the lighting. Another quiet way it hurts. You are accountable for the show, even if you didn't write the lines. There is a conference room word you used to love, hedge. Now there are words you tiptoe around. LJM, Raptors, Chuco. You remember the day the board approved something unusual. Your CFO could run outside partnerships that did deals with you. Vehicles designed to reduce earnings volatility, unlock value, smooth the flight path. The comfort then was in the word controls. Later, a report will call the arrangement fundamentally flawed. It will list approvals and deals, a lattice of related party conflicts. It will explain that the Raptor structures, meant to hedge equity-linked exposures, were weakened by design, propped by your own stock, and wired with triggers that tripped exactly when the company needed help. You read your initials on a page beside others you no longer say out loud. You remember a colleague in your doorway, paper in hand, asking if the hedge could really bear the weight. You said yes, because the quarter needed yes. Your SPE explainer lives in your pocket for relatives who ask what a special purpose entity even is. You say, imagine a messy attic you don't want guests to see. You rent a storage unit across town. That unit is separate from your house, so your living room looks tidy. In finance, an SPE can legitimately isolate risk, like putting a tricky asset in a storage unit with its own lock and its own insurance. But there are rules. The unit must truly be separate. You can't secretly control it and still claim it's not your mess. Related party deals are like lending your friend money to rent the unit and then paying yourself rent with your own gift cards. From a distance, it looks like storage. Up close, it's shuffling clutter. Why it hurts to be an executive here. If the storage units turn out to be mirrors, you're the one who signed the lease. The fix becomes the evidence. You keep a hedging explainer without jargon. A proper hedge is insurance. If you own a beach house, you buy hurricane coverage from a strong, unrelated insurer who will cut you a check when the storm hits. What you don't do is say, my house will pay for its own damage by selling seashells at a higher price right after the storm. That hedge fails exactly when you need it most. Tying insurance to your own stock is like stapling your umbrella to the wind. In good weather, it looks clever. In bad weather, it flies away. When markets turn, the protection evaporates, and the very thing you hoped would save you starts to pull you under. The executive version of misery is realizing your umbrella was a prop for the photo shoot. Now the cultural piece. Performance review committee, forced curves, rank and yank. On a whiteboard, it looks efficient, a bell curve that always finds the bottom performers. In a human system, it becomes a machine that rewards short horizons and sharp elbows. Behind the language of meritocracy, people whisper about withheld information, back-channel alliances, invisible knives. It rewards closing a deal today over understanding a risk that blooms next spring. You told yourself meritocracy is supposed to sting. You didn't notice how fear shortens attention spans. The spreadsheet can be long-term. Fear is always quarter to quarter. Then the verbs arrive. Announce, restate, reconsider, withdraw. You file an 8K. You say prior financials should not be relied upon. You explain related party transactions and consolidations, then reduce earnings by a number that won't fit on a cocktail napkin. You answer calls until your voice is a low ribbon of sound. Your inbox looks like a starfield. Ratings agencies ask long, gentle questions that feel like a medical history. Banks call about covenants. Your commercial paper desk mentions roll risk, which is code for if lenders won't renew short-term funding, cash can evaporate fast. A downgrade threatens clauses that make debt due sooner, which makes liquidity worse, which invites more downgrades. You learn the phrase death spiral in a room with bad coffee. You add a liquidity explainer for the non-finance brain. Think of your company like a busy restaurant that buys ingredients daily. Most days, suppliers extend easy terms because your credit is good. But if a rumor spreads that you might not pay, the vegetable truck stops extending credit and starts demanding cash on delivery. Now you need cash up front exactly when you have the least. So you borrow at high rates, which scares the fishmonger, who also demands cash. Suddenly, you're not cooking. You're explaining. Liquidity is oxygen. You only notice it when it's thin. Employees watch stock charts like weather maps. Some are caught in a 401k blackout, an administrator change, routine in theory, catastrophic in practice. They cannot sell while the price slides. You explain plan mechanics to people watching their net worth dissolve. There is no tone of voice that fixes this. You carry that conversation in your pocket forever. You practice answers that don't heal anything and still must be said. Your kitchen table 401k explainer helps outsiders. Big plans sometimes black out trading for a short window during a provider switch. Accounts are safe, but you can't move money for a bit. If company stock falls during that window, it feels like standing on a beach watching a wave erase your name. The window would have happened even in calmer seas. The timing makes it feel like a trap. Another way it hurts. Even neutral mechanics look cruel when the tide turns. A Sunday in December. Chapter 11. Subsidiaries listed like a phone book. Assets once spoken of with pride, now frozen on a line. The press calls it historic. The building feels too large. The atrium echoes. On Monday, the security badges sound louder at the turnstiles. You sit at your desk and realize how many decisions arrived disguised as momentum. Someone asks what bankruptcy actually is, and you try to make it kind. Bankruptcy is a court-supervised pause button. It stops the chaos of every creditor seizing at once. The court appoints a traffic cop, and the company breathes through a straw called debtor-in-possession financing. Things can be sold, things can be fixed, things can be mourned. Executives like you become museum docents of what used to be, guiding lawyers through exhibits with labels like Marketing Plan, Gas Transport, and Raptor 4 Revised. You never imagined your job would be to narrate your own archives. Your external auditor is convicted of obstruction. Later, a higher court vacates the conviction because the jury was told the law the wrong way. The name, by then, is a ruin the law cannot rebuild. Your CEO is sentenced to more than 24 years, then resentenced to 14, and one day released to sunlight and arguments about justice. Your founder dies before sentencing. The doctrine of abatement wipes the legal slate even as history refuses to. The law has its own rhythm. It does not resemble closure. As an executive, you learn you can be both central and replaceable, vital and vanished, quoted and forgotten, depending on which footnote a student happens to read. You rehearse an auditor explainer for non-accountants. Auditors are referees paid by the team, but expected to keep the game clean. They don't run plays. They make sure the scoreboard means what it says. If referees are pressured, distracted, or misled, the scoreboard can lie convincingly. After scandals, the rules change. Independent audit committees, partner rotation, firmer controls, heavier penalties for shredding records. None of it brings back the season, but it makes the next game a little harder to rig. Inside the company, a vice president writes to the chair in August and warns that the structures could make you implode in a wave of accounting scandals. She meets with leadership. She asks for a transfer. You tell yourself the warning is useful, like a fire exit or a seatbelt. Useful things are easy to ignore when the show is still on. Later, she becomes the face of a kind of courage you wish had been contagious. You wonder how many people tried to say something softer and gave up. Your whistleblower explainer is quiet. Whistleblowing isn't magic. It's a co-worker writing a memo with a tremble in the hand. It's walking into a meeting and asking a question no one invited. The system doesn't clap, it stares. Later, laws promise protections. In the moment, it's just a person in a chair saying, "Are we sure?" You add one more explainer, value at risk, without math. V. AR is a speedometer that tries to tell you the worst loss you might see on a normal day. It's not about apocalypse, it's how bad can bad get when nothing weird happens. The problem is the word normal. When the world goes weird, yesterday's speedometer shrugs. Executives sleep better when speedometer numbers are small. People learn to make them small. That's another way it hurts. Every metric becomes a high-score screen someone games politely. And credit ratings without jargon. A rating is a travel visa for your money. AAA means welcome everywhere. Junk means frisked at the door. If your visa gets downgraded mid-trip, hotels want deposits right now. You spend your vacation explaining you can still afford the room. In corporate life, that explanation is called a liquidity plan, and it is a bedtime story you keep telling bankers until the bankers fall asleep or you do. Board duty. In plain words, duty of care, duty of loyalty. Care means you asked the obvious questions and read the footnotes like a detective. Loyalty means you put the company's interests ahead of friendships and upside in side deals. When boards bless conflicted structures, they don't just fail legally, they break the spell that tells employees the grown-ups are watching. If you're an executive, that broken spell is your weather. It rains second guesses. It hails rumors. The forecast gets personal. Compensation, gently explained. Options feel like lottery tickets for doing your job well. They also turn the stock chart into a mirror that shows you taller or shorter, depending on the closing bell. Restricted stock is slower, sturdier, less intoxicating. Rank and yank makes options feel like oxygen. Hit or be hit. That's how good people end up solving for the wrong variable, earning applause from a future they haven't earned yet. Media training day arrives. Bridging, blocking, flagging. Little phrases meant to ferry you across hostile water. What I can say is, the real point here is, you practice on a stool while a camera adds 10 pounds and removes 10 IQ points. Afterward, you walk the long hallway back to your office and realize that your job has become the art of answering questions without changing the temperature in the room. You become good at it. That's the problem. In the calm after midnight, you tidy your desk with small, unnecessary motions. A pen aligns with the legal pad. A paper clip becomes a straight line. The binder closes with a hush. You glance at the skyline. The city lights look like data points, neat and neutral. You wonder when the line on the chart stopped being a measure and became a spell. You remember the offsite where someone wrote "Think bigger" on a flip chart, and everyone clapped because it was safer than asking, "Bigger than what?" You remember the hallway congratulations after a quarter beat, the coded congratulations that meant, "We made the model smile." You remember the first time you practiced the phrase, "No further comment," and how easily it fit in your mouth. Regulators arrive with tote bags and patience. Depositions feel like time-lapse plants. Nothing, nothing, nothing. Bloom. You say, "I don't recall," when you genuinely don't, and the room treats the words like choreography. You answer carefully because words become exhibits, and exhibits become narratives, and narratives, once printed, do not sleep. You get used to the fluorescent hum. You start bringing the same pen for luck. At home, dinner is a negotiation with silence. A kid asks why the news says your company was smart but not good. You explain that smart is a tool, not a virtue. That good is a direction, not a label. That sometimes adults forget the difference because applause is loud and questions are quiet. You tuck a small person into bed and choose a story with a map and a compass. You point to both. You practice an ethics explainer that doesn't sound like a lecture. Ethics is not, "Don't break the law." That's the flaw. Ethics is, don't design a hallway where breaking the law would be the only way out. It's building rails so that clever does not outrun clear. It's writing the memo you would want your younger self to find in a drawer. The reforms arrive with their own tone of voice. Certifications, internal control reports, independent audit committees, clawbacks. You sign things you used to merely review. You certify things you used to assume. You now say material weakness out loud, like a weather alert. The pendulum swings from swagger to paperwork. For a while you resent it. Then you realize paperwork is how a system remembers what it promised. The new executives, the ones who learn to lead after you, keep more notes and fewer secrets. You try to be glad for them. Analyst day again, in another life. PowerPoint slides that tell cleaner stories, footnotes that speak like adults, Bridges from GAAP to non-GAAP that don't require a Sherpa. You insist on one slide that says, "Here is how we make money," with 3 bullets and no poetry. You ask for a simple diagram showing where cash enters and where it can leak. You learn that simplicity is not dumbing down, it's standing up. You build a tiny handbook for your future self. If the hedge is funded by your own stock, it isn't insurance. If a partnership can't survive without your wink, it isn't independent. If an earnings line can only be explained by a metaphor, it isn't durable. If a metric improves when the world gets weird, the metric might be a costume. If a culture needs fear to run fast, it will eventually run crooked. You keep the handbook in a drawer with the good pens. Investors again, the quiet ones. You picture retirees at kitchen tables, folders spread out, trying to understand why a word like restatement doesn't mean try again. You picture a teacher looking at a 401k statement and wondering how ambition and arithmetic can team up to ruin a weekend. You stop picturing and start writing. A letter you wish someone had written earlier, explaining in normal words what your company does, how it wins, how it could lose, and what would make you change your mind. You put the letter on the website. No one applauds, that's fine. It isn't for applause. So why did it suck to be an Enron executive? Because you were paid to sell certainty and you lived with doubt. Because the machine rewarded cleverness over clarity. Because every fix created its own gravity. Because people got hurt. Because the same skills that built brilliant structures also built traps. Because even when you did nothing illegal, you sat too close to decisions that made truth optional. Because opacity feels exciting right up until someone asks a simple question. Because smart is not the same as safe. Because your job turned into a museum tour of your own assumptions. Here's the part you say only to yourself. If you could rewind, you would draw one small map that explains the business in a paragraph. You would ask, what pays us now, what pays us later, and what could make both stop? You would demand that hedges be real insurance that does not share your DNA. You would pay people for steady courage, not acrobatic earnings. You would make the auditor explain your own footnotes back to you in plain speech. You would treat culture like a control and reputation like an asset. You depreciate if you stop investing. You would keep a list of questions that sound dumb and turn out to be the ones that save you. Everything that happened, happened. The numbers won't unadd themselves. The filings won't unfile. The hearings won't unhear. But your breathing can slow. Your shoulders can drop. Your mind can let go of the quarter. If anyone asks what you learned, you can say, the future should not have to arrive early to make the present look good. The attic should not pretend to be a separate house. Insurance should not blow away in the wind. And the simplest questions deserve the first answers. Office night sounds drift in. The printer warms, then cools. A distant laugh in a stairwell, too loud, then small again. Shoes on carpet. A door size shut, somewhere you will never find. Phones blink to themselves. An email ping arrives and disappears. The building feels like a sleeping animal. You sit with the quiet until the quiet sits with you. Binder shuffle. Plastic rings click. Tabs whisper, EES, broadband, wholesale, hedging. A page smooths under your palm. A coffee ring circles a footnote. Close the binder. Open it again. Elevator hum. The car nudges upward. Walls reflect you into a corridor of executives. The display blinks patiently. 27, 28, 29. The doors tremble, then part. You are an Enron executive. You know how to make numbers behave. You also know how numbers can behave like weather. Some nights the forecast is honest. Some nights the forecast is a wish. On the way out, you switch off a lamp and leave the hallway lit like a runway at night. You touch the elevator button with one finger, lightly, as if it might bruise. You watch the numbers descend. Outside, Houston is a net of lights. Inside, the car breathes. You are an Enron executive, and you are very tired, and you are finally going home. Before you sleep, you make one more promise. No spreadsheet can enforce. Next time, the map first. The paragraph first. The simple question first. Then the innovation. Then the pride. If you need the short version of why it sucked to be an Enron executive, here it is, plain and simple. You were paid to sell tomorrow today, so forecasts became promises you had to live inside. You used clever structures that looked like insurance but depended on your own stock. So the umbrella blew away in the storm. The culture prized quick wins and fear-managed performance, so long-term judgment kept losing to short-term applause. Complexity and off-balance sheet storage made the business hard to explain, and the moment someone asked, "Where's the cash?" the magic faded. Confidence was oxygen. A ratings wobble or a liquidity squeeze could turn routine funding into a panic. You carried legal and reputational tail risk that outlived the job. Investigations, depositions, headlines that never sleep. You owned the blast radius of trading antics and market gaming, even if you didn't script them. Your people, especially those with retirement tied to company stock, got hurt, and you had to look them in the eye. Guardrails failed. Auditors collapsed, boards missed conflicts, and you learned that controls are only as good as the questions asked. And beneath all of it, the personal cost, living with doubt while speaking in certainty, sleeping beside a spreadsheet that kept whispering, "Are you sure?" You are on a quiet trading floor in Hong Kong, very late. The building hums, the city glows. Screens float in the dark like little aquariums. You are a senior executive at Noble Group, a global commodity trader that made its name moving raw materials and pricing risk over years, not days. You don't just ship coal and metals, you ship promises, deliveries next quarter, next year, 5 years from now. You know the public story by heart. You connect mines to mills, fields to ports, smoothing volatility so customers can focus on making steel instead of betting on weather. Inside the company, the quieter story is about valuation. A meaningful share of reported profit depends on how you value long-dated deals today, marking to market years of future cash flows and recognizing part of that value now. When markets are deep and observable, that's normal. When markets are thin and tenors are long, you lean on unobservable inputs, level 3 in the fair value hierarchy under IFRS 13. That is permitted. It also means your line on the income statement rests on your judgment about a future you haven't lived yet. You keep a friendly explainer for new analysts. Imagine you sign a 10-year offtake contract. Old school accounting would recognize revenue as you deliver each year. Mark to market says, if you can estimate the fair value of the whole 10 years today, you can book a gain now and true it up later as prices move. The longer and foggier the road, the more the number depends on your headlights rather than streetlights. That's level 3, driven by significant, unobservable inputs. One morning, a research blog jolts your calm. Iceberg Research publishes a report arguing, Noble is recognizing large non-cash gains up front on long-dated contracts and investments. A figure repeats in headlines. About $5.8 billion of positive contract fair value gains assetted on the balance sheet, more than the group's equity at the time, they say. Your team disputes their framing. Your auditors have signed off. Still, the number lodges in investors' heads like a burr. In the afternoon debrief, a trader shrugs. It's just level 3. Everyone uses models. Your risk head replies softly. Everyone uses models. Not everyone leans on them this much. Your boss leans back and asks you to prepare a one-page explainer for the board. No Greek letters, no footnote labyrinth. You nod, and the job starts to feel like translating weather into cash. You also field questions about a listed associate. Iceberg points to a stake whose carrying value on your books sits far above its market value. They argue this gap is part of a wider optimism problem. You can debate the methods. You cannot debate that charts move faster than memos. The next part is about credit, your oxygen. Commodity traders breathe short-term funding, revolving lines, letters of credit, inventory finance. In early 2016, S&P cuts Noble to junk, citing volatile earnings and large mark-to-market losses as prices fall. Your share price slumps. Your cost of money rises exactly when you need it to fall. The downgrade isn't just a label, it's a toll booth on every bridge you must cross. You print the 2015 results, a US $1.67 billion loss, your first in nearly 20 years, after write-downs and a bruising coal market. You tell investors it's a reset. The market hears exhaustion. Your inbox fills with polite requests for more color on level 3 sensitivities. You start to dream in discount rates. Your days become conversations. In the 8 a.m. stand-up, the CFO asks for a clean bridge from accounting profit to operating cash. Keep the bridge simple, he says, tapping the table. If we have to sing it, the tune is wrong. You email finance for the level 3 roll forward and sensitivity tables, which inputs moved, by how much, and how much of last quarter's profit is a mark that needs years to mature. Finance replies with a spreadsheet and a sigh emoji someone forgot to delete. At lunch, a desk head complains about tighter limits. If we cut VAR again, we're just babysitting positions. You remind him that when credit tightens, your job is staying funded, not looking clever. He mutters something about the iceberg discount and asks if you'll defend the coal marks in the risk committee. You say yes because the quarter needs yes. In the afternoon, you brief investor relations. Plain English, you say. Level 1 is a screen price. Level 2 is a price derived from observable data. Level 3 is our model because the market is thin. We disclose the inputs and the sensitivity. We stress them. We move them if the world moves. You practice that until the sentences feel like rails. The valuation debate spills into everything. You sell the agriculture unit to raise cash. You shed assets you once called core. Each sale buys a month of oxygen and a year of regret. The board meeting stretches into the evening. What else can we sell without selling the story? Your chair asks. No one answers quickly. Nights are for explainers you wish you didn't need. You write one about collateral, a security deposit your lenders and trading partners ask for when they're not fully sure your models will match reality. If they grow nervous, because prices swing or headlines multiply, they ask for more deposit now. That drains cash precisely when your marks are under fire. You write another about hedges. Real insurance pays when pain arrives. A hedge that depends on your own equity price, or a curve that evaporates in stress, is an umbrella that looks good in photos and vanishes in wind. The auditors come through with portable whiteboards and patience. You walk them through your long-dated contract models, the forward curves you can observe, the anchor price you must set for years beyond the curve, the discount rates, the credit assumptions. You point to the disclosures in your financials that describe exactly this: the classification into Level 2 or Level 3, the use of valuation models, the adjustments you make when observable data runs out. You are thorough. You are tired. Your CEO calls a floor-wide town hall. "We are not Enron," he says, too loudly. Everyone laughs, too quietly. Afterward, your boss pulls you aside. "We need to be boring for a while." You nod. Boring is expensive when it means selling assets at the worst moment, but it's cheaper than the alternative. Iceberg keeps publishing. They say impairments are coming. You insist the marks reflect economic reality across cycles. Months later, you take more write-downs on contract valuations and assets. You tell the market you are de-risking. The research shop does a victory lap. You do not read it. Here is where the job begins to suck in ways spreadsheets can't show. The conversations with bosses and co-workers turn into a maze of incentives. Your comp plan still leans on near-term targets. Guidance has become a cage. The trader wants room. The risk team wants smaller bets. The CFO wants the quarter survivable. The chair wants lenders calm. You build a deck that makes each of them a little unhappy, which means it's probably fair. The rating agencies call again. The analyst's tone is dentist gentle. "Walk me through your liquidity plan if the forward curve falls another 10%. You answer calmly. You try not to imagine the forward curve falling another 10%. Later, you see the note. Outlook negative. You reread the sentence about volatile earnings and large mark-to-market loss in 2015, and you feel your jaw clench in a way your dentist would disapprove of. By autumn, the war room moves from trading to law. Advisors sketch a path. Courts supervise schemes of arrangement in England and Bermuda to restructure the debt and transfer the business into a new company, with recognition in the US under Chapter 15, so counterparties and lawsuits don't collide across borders. Judges will need to be satisfied about creditor classes, voting thresholds, and fairness to dissenters. It will be, as a practitioner's bulletin later writes, of the utmost complexity. You practice the word scheme until it stops sounding like a confession. On the floor, culture changes color. People talk softer. The proud ones leave, the stubborn ones stay. A junior analyst stops by your desk and asks if she should quit. You tell her the truth. You don't know. She thanks you for not pretending. That thanks sits in your pocket longer than you expect. The scheme meetings come and go. Creditors vote by overwhelming value majorities. The English and Bermuda courts sanction. The US court recognizes the foreign proceedings. A smaller successor emerges. New lenders, new stack, old fatigue. The press calls it a lifeline. It feels like a life raft. You think the story might fade. Then years later, Singapore's authorities announce enforcement after a multi-agency investigation. A civil penalty for publishing misleading information in financial statements between 2012 and 2016. The words misleading information enter your company's Wikipedia page and never leave. You can argue good faith judgment. You cannot argue the permanence of phrasing in a regulator's press release. You build more explainers for the next town hall. Fair value hierarchy in one breath. Level 1 is a quoted price you can see. Level 2 is derived from observable data. Level 3 is your model when markets are thin. IFRS 13 requires you to disclose the inputs and explain how sensitive the valuation is. What happens if the discount rate rises? If the curve falls? If the credit assumption worsens? You show that page in the annual report like you're pointing to an emergency exit. Now the part about the bosses, up close. The chair prefers simple stories, where the cash enters, where it might leak. He circles the word cash with a pen, as if the circle itself makes it more available. The CEO wants to project control without promising miracles. Stick to facts, he says, but pick the facts that travel. The CFO wants to hold the line on covenants. He hates surprises more than he hates bad news. The risk chief wants hedges that pay when pain arrives. She is unimpressed by pretty charts that melt in stress. Every one of them is right in a different way. You walk from office to office as a translator, and translation is lonely work. You spend a late night with the modeling team. The forward coal curve is observable for a few years, then darkness. Someone has to set the anchor price for years beyond the forward strip. Last quarter's anchor looks too high. You lower it, the model sighs, the P&L flinches. You write the disclosure the next morning. Valuation adjustment relates to a change in long-term coal prices reflected by a lowering of the anchor. Coal price used for projecting periods beyond observable market data, and you feel older than your email signature. At 11 p.m., legal teaches you the choreography of cross-border restructuring. Class constitution, scheme terms, recognition mechanics. You learn new phrases, third-party releases, sanction, effective date. You will read later that 99.98% by value of scheme creditors approved in England, that Bermuda sanctioned, that a New York court recognized under Chapter 15. You will feel both relieved and hollow. Morning brings a different pain. People. Someone from HR asks if the redundancy memo should go out before or after the next trading update. You stare at the ceiling tiles because there is no right answer. A colleague's spouse corners you at a school event. Does misleading mean lying? You try to explain that accounting can be technically compliant, yet still mislead, that level 3 is allowed and disclosed, that hindsight is a cruel editor. You sound careful. You do not sound convincing. You start keeping a pocket handbook for yourself and for the next person who sits in your chair. If level 3 gains are doing more lifting than level 1 cash, translate the inputs into 3 normal sentences and 1 sensitivity table, or don't book them yet. If a hedge depends on your own equity or a curve that vanishes in stress, it's not a hedge, it's an echo. Stress it until it squeals. If a carrying value for an investment stays far above market value for too long, assume your model, not the market, must move first. If a rating outlook turns negative, treat it like a weather alert and write the liquidity plan a stranger could audit. Mid-quarter, the audit committee wants a walkthrough of level 3 controls. You bring the roll forward, the model validation notes, the independent review summary. You acknowledge where judgment sits. You resist the urge to sell certainty. IFRS 13 never promised certainty. It promised measurement and disclosure. You realize, uncomfortably, that you have been selling certainty anyway, because certainty wins short meetings. A trader stops by with a new idea, a long-dated offtake at an attractive discount. The mark is beautiful, he says. The risk chief raises a hand. Is the counterparty strong enough to live through the curve? You balance eyes. The idea is elegant. The oxygen is low. You say, no new long-dated marks until we rebuild headroom. The trader leaves frustrated. The risk chief leaves grateful. You stay behind and stare at the curve like it might apologize. You visit operations to remember what the business feels like when it isn't paperwork. A supervisor points to a map of rail cars inching toward a port. These move, she says, no matter what the accountants argue. You nod. That nod is the best part of your day. Investor calls return. You explain again that non-cash fair value gains are not pretend. They are real estimates that can reverse. You point to the sensitivity table. The investor says, so if your discount rate goes up and your anchor price goes down, the gains fall? You say yes. He thanks you for the clarity. Later you see a blog post calling your answer alarming honesty. The line between clarity and alarm is thin. The schemes become effective. The press release says, restructuring completed. Papers are signed, entities are renamed, charts are redrawn. You walk the empty floor at night and think, completed is not the same as complete. A year passes. The headlines quiet down. Then comes the enforcement announcement from Singapore. A 12.6 million Singapore dollars civil penalty for publishing misleading information in financial statements for the 2012 to 2016 period. The wording is careful. The effect is blunt. No spreadsheet unprints a press release. You debrief with the team. The CFO circles back to basics. From now on, every investor pack gets 4 slides. How we make money, where cash enters, where it can leak, and how level 3 could move under stress. The risk chief adds, and a map from non-GAAP to GAAP that doesn't need a Sherpa. The chair says, good. Boring is a moat. You think, I wish we had said that out loud 3 years ago. In the kitchenette, a colleague says the quiet part kindly. This place made very smart people live inside very brave assumptions. You both stare at the microwave as if it might offer absolution. You write one last explainer for yourself. If your story depends on valuation judgments that kitchen table readers can't sanity check, either A, publish the exact inputs, the ranges, and the sensitivity, with examples that survive a supermarket checkout line, or B, stop telling that story as if it were cash. The world can forgive losses. It does not forgive feeling fooled. The building is quieter than usual this Monday. The air feels like paper. You pull a chair closer to the table for the funding call. The CFO's voice is careful, like he's carrying glass. Let's keep it simple. Availability, headroom, maturities. Treasury reads the numbers. Risk asks for stress cases. You present a slide with 3 calm boxes. Now 30 days, 90 days. The chair asks only one question. What's the one thing that would surprise us? You answer, a large counterparty asking for cash early. Everyone nods. No one exhales. Here's a soft explainer you keep for yourself about letters of credit. The oil that lets cargo move while cash catches up. A letter of credit is a promise from a bank. If paperwork is clean, the bank will pay the seller and you'll pay the bank. When banks feel calm, letters flow like tap water. When they feel watchful, they ask for more collateral, more fees, shorter terms. It's not a scandal, it's a mood. But mood moves money. On the floor, a trader wants to expand a position that looks brilliant on the curve. The mark is beautiful, he says. The risk chief looks over the top of her glasses. Does your beauty survive if tenors shrink? He frowns. You translate. If we have to fund this shorter and post more margin, the pretty number turns shy. He nods, but doesn't love it. He thanks you in a way that means, I disagree, but I'll comply. You spend an hour with operations because reality lives there. A manager shows you a board of rail cars moving toward port, small magnets inching along a map. Our job is to keep the magnets moving, she says. You are grateful for sentences that still point somewhere. Back upstairs, investor relations drafts answers for the next call. You sit with them and smooth the verbs. No heroics, no metaphors that outpace math. Explain the cash bridge in 3 lines, you say. Operating inflow, working capital changes, financing, no poetry. They smile. The IR lead says, I'll put the poem in the notes and the cash in the slide. Afternoon brings the audit committee pre-brief. You walk the group through your level 3 controls like you're touring a museum. Model owners, independent validation, sensitivity ranges, sign-offs. You mention that lowering a long-dated anchor price made the quarter flinch. The chair says, thank you for doing that now, not later. It lands like a gentle benediction and a warning. Do not make the future fix the present. In the hallway, the CEO stops you with a hand on your shoulder. Clarity over comfort, he says, almost fatherly. If you have to choose, pick clarity. You realize how rarely anyone says that out loud when targets are near. That evening, you draft a small explainer about inventory finance. How a trader can own a cargo for only a sliver of the voyage if banks front the rest. How cost of carry matters when prices drift. How a slight rise in funding costs turns a decent trade into a polite regret. You add a line you wish were famous. A business can be solvent and still suffocate. Tuesday starts with co-worker weather. A senior originator, brilliant and blunt, announces he's leaving. I don't want to spend 2 years apologizing for last year's assumptions, he says. You shake his hand and tell him he made many good decisions. He says, so did you. The world moved. He is not unkind. He is done. At lunch, a junior analyst sits at the edge of your table. I built the sensitivity you asked for, she says, sliding a file across. You open it and see 3 columns: base, cloudy, storm. In storm, the anchor price falls, the discount rate rises, the credit spread widens, the fair value gain thins to a whisper. She looks worried. You tell her, this is good work. It's better to know where the floor is than to pretend we're floating. Her shoulders drop. Sometimes management is just permission to tell the truth the model already knows. In the risk committee, you take a breath and cut through the ritual. New rule, you say softly. No new long-dated marks without a matched funding plan we could live with if our rating got worse. A trader sighs loud enough for the table. The risk chief raises an eyebrow that says thank you. You leave the meeting feeling like you moved a lever no one will applaud you for. Midweek, legal runs a mock deposition so senior leaders learn how to answer clearly. You practice, I don't recall, when you truly don't. At the time, our basis was, when you do. It feels theatrical. It is also sensible. Words become exhibits. Exhibits become narratives. Narratives outlive pay cycles. That night, you call a supplier you've known for years. Their controller answers on speakerphone. You can hear clatter, laughter, a forklift far away. You ask for 1 more week on a payment you know you'll make. He says, we're fine, but my boss reads the papers. You answer, send him the invoice schedule. I'll sign it myself. He says, that helps. Trust is a small daily wire transfer. Thursday is for war games. Treasury and risk run a tabletop. Curve down 10%. Counterparty downgrade. Letter of credit haircuts increase. You watch the spreadsheet drain like a bathtub. You hate how thrilling it is to solve fake problems while real ones wait. You end the session with a rule. Publish the liquidity playbook you just rehearsed. Names, numbers, sequence, thresholds. So next time, practice turns to procedure. Later, the CFO asks for a quiet office. You both sit. We need to stop promising what models might do and start promising what cash can do, he says. You agree. It sounds obvious because it is. You write the sentence on the whiteboard anyway and circle it twice. Friday's town hall has a different shape. Instead of slides about new deals, you show simplified maps, where money enters, where it can leak, what collateral means in plain language, how sensitivity turns a handsome number into an honest one. People nod. A skeptic raises a hand. What happens if the curve does the bad thing? You say, we've planned for it. It won't be fun. It will be survivable. You watch relief and disappointment share the same chair. After the Q&A, a colleague you've clashed with corners you by the printer. You made me look slow in the meeting, he says. You apologize, not for the content, but for the tone. We're on the same side of the ledger, you say. He grunts, then says, I'll bring you the counterparty updates Monday. Truces are measured in follow-ups. Over the weekend, you open a previous annual report and reread the fair value note like a bedtime story. You trace the level 3 roll forward with your finger, line by line. You wish the table came with 3 postcards. Here's what we assumed. Here's what changed. Here's how wrong we might be. You make a note to suggest exactly that next quarter. Postcards for footnotes. By Monday again, headcount decisions arrive. HR asks whether to announce the reductions before or after the funding update. There isn't a right answer. You choose before, and you go to the floor to say it yourself. You don't use right-sizing. You use, I'm sorry. Grown-up words, steady voice, no promises you can't keep. People thank you for being present. It does not feel like gratitude. It feels like gravity. You start a mentor circle on Wednesdays. 4 juniors, 1 hour, no agenda except questions. You walk them through why discount rates matter, why credit spreads matter, why cash conversion matters more than a model's smile. You tell them to write 1 page after every big decision. What we believed, what we needed, what would change our mind. You wish you had done that for every quarter of your career. The chair calls you in late one evening. He has a yellow pad and a tired kindness. 3 sentences, he says. If you could rewrite the last 2 years with 3 sentences at the start, what would they be? You say, here's how we make money. Here's how we could be wrong. Here's how much wrong we can afford. He nods. Put those on page 1, he says. Page 1 is where maps belong. As the restructuring grinds toward effective dates and new letterheads, you learn to separate legal success from human relief. Papers get stamped, entities get renamed, charts get redrawn. Relief arrives as a whisper, not a cheer. You go home early one night, 9 p.m., and sit in the dark kitchen, letting silence decide how long it wants to stay. Weeks later, enforcement headlines surface with words you hoped wouldn't. You read them in the morning and answer questions all afternoon. In the evening, you call your team and say the only thing that feels decent, thank you for the work. Here's what we'll fix next. You open a new document titled Plain English Disclosures We Wish We'd Had. You start with level 3 inputs, sensitivity, cash bridge, liquidity playbook, hedge effectiveness. You do not write poetry, you write checklists. You also start a tiny ritual. Before any deck goes out, you read it aloud in the tone you use to explain things to family. If a sentence feels like it hides, you rewrite it until it walks into the room. It slows meetings. It speeds trust. On a quiet night, the risk chief sends a one-line email. Thank you for picking clarity. You stare at it longer than the words require. Then you reply, thank you for insisting on it. That's how culture changes. Not with slogans, but with two people refusing to move the goalposts in the dark. You end where you began. At your screen, curves like low hills at dusk. Noble Group is smaller now. The numbers don't glow like they used to. That's fine. You save the spreadsheet, close the window, and leave a sticky note for morning. Map first, cash second, marks last. The note is not profound. It is merely useful. Sometimes useful is the highest praise a business can earn. So, why did it suck to be a Noble Group executive? Because you were paid to sell calm while living inside models that could turn fragile overnight. Because liquidity depends on confidence, and confidence is a temperature, not a fact. Because you recognized profit today from decades you hadn't lived yet, and then had to live inside those numbers. Because downgrades made your oxygen expensive. Because cross-border schemes can fix balance sheets, but not reputations. Because a single regulatory phrase, misleading information, outlives rebuttals. Because every choice, defend the mark or drop it, sell assets or starve, speak simply or speak safely, felt like a betrayal from one angle or another. The shortest version, fair value earnings felt like income until the market asked for cash. Ratings fell and funding tightened. Assets were sold. Multi-jurisdiction schemes moved the pieces. And later, Singapore called some disclosures misleading. The company didn't explode, it thinned out. That is a slower pain, quieter, longer, harder to explain to people who counted on you. Thank you for listening. If this calm business story helped you wind down, maybe taught you something quietly, please like this video and subscribe. Your support helps more of these slow, careful episodes find the people who want them and